A single statement from Donald Trump just forced smart money to reposition. The gold market didn't react emotionally. It voted. And when gold votes, it is never random. Because gold is not just a metal. Gold is a verdict against the system, against the dollar, against the promise that governments will protect your wealth. And right now, that verdict is being delivered loudly, while most people are still distracted. And the people who control trillions of dollars already saw it. The question is, did you? Let us go back to the basics for a second, because this matters for everything that follows. The United States dollar has been the world's reserve currency since 1944. That means almost every country on Earth settles its debts in dollars. Oil is priced in dollars. Trade is settled in dollars. Debt is issued in dollars. The dollar is the operating system of the global economy. And for 80 years, that system has given America one extraordinary privilege. America gets to print money. America gets to spend money it does not have. America gets to run deficits that would collapse any other country. Because as long as the world needs dollars to do business, there will always be demand for those dollars. But here is the thing about power. It does not last forever. And right now, that power is being questioned in ways we have not seen in decades. That is where gold comes in. When powerful political figures start making statements about the dollar, about trade, about who owes what to whom, the gold market listens before the news cycle even starts, before analysts write their reports, before the financial media has its talking points ready. The gold market moves first. It always has. It always will. What happened recently is not complicated, but the implications are massive. Statements were made about tariffs, about trade relationships, about the balance of economic power between the United States and the rest of the world. And buried inside those statements, if you know how to listen, was something that rattled the confidence of institutional money. Not because the statements were wrong, not because they were right, but because they introduced uncertainty. And uncertainty is gold's best friend. Here's a number you need to hold in your mind. 36 trillion. That's the current debt load of the United States government. $36 trillion. That number was 12 trillion just 15 years ago. It tripled in 15 years, and it is accelerating. When you hear political statements about restructuring trade, about demanding payments, about using economic leverage to rebalance global relationships, what smart money hears underneath all of that is one question. How does this debt get resolved? There are only a few ways to deal with debt at that scale. You grow your way out of it, you default on it, or you inflate your way out of it. Growing out of $36 trillion of debt at the speed it's accumulating is mathematically unrealistic. Default would collapse the global financial system, which means the most likely path, the quiet path, the one that does not make headlines, is inflation. Slowly, steadily, quietly, making the value of that debt smaller by making the value of the dollar smaller. And when the dollar gets smaller, gold gets bigger. Every single time throughout history, without exception. This is not a theory, this is not speculation. This is the pattern that has played out across every major empire, every major currency crisis, and every major moment of geopolitical realignment in recorded history. Go back to Rome. The Roman Empire did not fall in a day. It was a slow bleed. Coins were clipped. Silver content was reduced. More currency was created than the economy could absorb. Slowly, the purchasing power of Roman money collapsed. The people who held gold survived. The people who trusted the system did not. Go back to Weimar Germany. People needed wheelbarrows of cash to buy bread, not because bread became more valuable, but because the currency became worthless. Those who held gold converted it into property. businesses, and real assets. Those who held cash watched their life savings evaporate. Go back to 1971. Richard Nixon closed the gold window. The dollar was formally decoupled from gold. In the decade that followed, gold went from $35 an ounce to over $800 an ounce. 22 times your money in 10 years. Not because gold changed, but because the dollar did. Now look at where we are today. The dollar is under pressure from multiple directions at once. Trade tensions are reshaping global alliances. Countries that once held dollars as unquestioned reserves are quietly diversifying. Central banks around the world have been buying gold at the fastest pace in 50 years. 50 years. Central banks are not retail investors. They don't buy gold because they saw a video. They don't buy gold because they're scared. They buy gold because they have the best economists, the best analysts, and the most sensitive data pipelines on the planet. And those people are telling their governments the same thing. Buy gold, reduce dollar exposure, hedge your reserves. That is not a coincidence. That is a strategy. And it accelerated in 2022 when Russian dollar reserves were frozen in response to the war in Ukraine. That single decision sent a shockwave through every central bank on Earth, because every country holding dollars suddenly realized something important. Those dollars can be turned off. They can be frozen. They can disappear overnight by political decision. So they started buying gold. Because gold cannot be frozen. Gold cannot be sanctioned. Gold does not need a counterparty. Gold does not exist on a server that can be switched off. Gold just is. Now add political uncertainty on top of an already fragile system. Statements about trade, about tariffs, about restructuring relationships that have existed for decades. Each statement sends another wave through the gold market, not because of politics, but because of what those politics reveal, the fragility underneath. Here is what most people completely missed. The language shifted. In political statements, in bond markets, in currency markets, in the quiet movements of institutional capital that never make headlines. Sovereign wealth funds began rotating capital, slowly, quietly, consistently. When a sovereign wealth fund moves even 1% of its allocation, that is billions of dollars. When several move together, that is a tectonic shift in capital. And that shift is happening right now. This is the information gap that has always existed. The people at the top of the financial system see what is coming before everyone else, not because they're smarter, but because they have access. And when they move, the asset they move into rises. Those who were already positioned benefit. Those who were not watch from the outside. This is how wealth has always transferred. Quietly, through information asymmetry. So the question you have to ask yourself is simple. Which side of that gap are you on? Gold has moved dramatically over the last 2 years, not because the world suddenly discovered gold, but because it remembered what gold is for. Gold is for moments like this. Moments when the financial architecture starts showing cracks. Moments when promises sound hollow. Moments when the numbers stop adding up. 36 trillion in debt and counting. Central banks buying gold at a 50-year record pace. Political uncertainty shaking currency markets. Trade relationships being renegotiated at the highest levels. Every one of these forces point in the same direction. And the people who understand this have already moved. Some moved months ago. Some moved years ago. The question now is not whether gold will continue to reflect this reality. The question is whether you will be positioned before the next wave or after it. Because in every historical example, the move in gold does not wait for the crisis to be obvious. By the time it is obvious, the move is already done. The people who bought gold in 1970 did not know the exact day the gold window would close. They knew the system was under pressure. They positioned themselves early. And when the system broke, they won. The people who bought gold in the early 2000s did not know the exact moment the housing market would collapse. They knew debt was growing unsustainably. They knew risk was mispriced. They positioned early. And when the crisis hit, they were protected. Right now, the signals are louder than they were in either of those moments. Debt is bigger. Political uncertainty is clearer. Institutional behavior is more visible. Central bank buying is public. And yet, most people are still waiting. This is the quiet wealth transfer, happening in plain sight. Institutions are hedging themselves with gold. They are protecting their balance sheets. But the products sold to everyday investors remain stock-heavy and dollar-denominated. They are hedged. You are not. That asymmetry is the real story. Not just a price move, a structural shift, a reordering of who holds what kind of wealth and why. You now have the same information that took institutional analysts months to piece together. You understand why gold is moving. You understand the signals. You understand where smart capital is going. The gap just closed. What happens next is up to you. You can do nothing. Wait. Watch. By the time the headlines confirm it, the opportunity will already be gone. Or you can decide not to be on the wrong side of this wealth transfer, not because someone told you to, not because of blind optimism, but because the data is clear, the history is clear, and the direction of institutional capital is clear. The gold market reacted to those political statements because it understands something the mainstream still avoids. The system is under pressure. The dollar is being questioned. The debt cannot be grown away. And the people who understand this best are already positioned. The only question that remains is whether you will be too. This is SHF Money. Stay sharp, stay early. See you in the next one.